It's interesting. We've noticed a shift in the types of litigation that we've seen. Historically, directors and officers liability insurance claims have been driven by shareholder securities class actions. And there's tended to be maybe 200 a year on average in the absence of some bubble or some event that might occur. And that's been fairly steady over time. However, we've also noticed more recently that we're seeing a shift away from just securities class actions. And now we're also seeing general breach of fiduciary duty suits and also other types of claims brought by regulators and by law enforcement agencies directly. And that's a shift. So from shareholders to regulators. And that's a trend that we've seen, especially in the last 12 to 18 months. I think the nature of the activity around the new regulatory environment that we're in and with all the changing legislation is going to mean that there's a much more active regulatory bodies like the SEC, the Department of Justice, and others who are going to be looking more closely at companies with all the requirements they have for additional disclosure and new obligations. So I think being aware of what those obligations are and those new disclosures under this new legislation, and then expecting that it's likely that there will be some kind of an investigation at some point or an inquiry. And when that occurs, to have a process in place as to how you're going to respond and who's going to help you along the way. A significant amount of expenses can be incurred by hiring attorneys and responding to these investigations. So some prep work, if it does happen, how you're going to respond, and what attorneys and advisors are you going to bring in to help you is important. I think before a crisis, specifically D&O insurance, as I said earlier, it's important to understand how the policy works and make sure that you understand how the policy is triggered and what requirements you have under that policy in terms of the notice provisions and the mechanics of how it works. During a crisis, it's important to make sure that you're in communication with your insurance carrier. Oftentimes, companies are thinking about all the other issues that are on their plate, but if they're in discussions and settlement and they're talking with defense counsel on a litigation strategy, it's very important that they engage the D&O insurer in that process. And after the crisis, it's important that they maintain that relationship and on a going forward basis, that the insurance company and the carrier and the customer and the board understand what the implications might be in terms of their going forward coverage and make sure that they've got a good relationship so that there aren't any bumps along the way. There's been a lot of discussion around how the policies respond to investigations and investigative costs and around the definition of a claim. In other words, when does a clock start ticking when a company starts to incur some costs? So we need to make sure that those provisions around the investigations are clear in terms of how the policy responds and what expenses are paid, and again, when the clock starts ticking. So that whole issue around investigative costs is important. And also in terms of the cancellation provisions, that the policy is non-rescindable, that policy cannot be voided or rescinded by the carrier for any reason. And the third thing I would say is Side A, non-indemnifiable coverage. Boards need to make sure that from an individual perspective, in the absence of any indemnification, either by law or because of bankruptcy, if they're not able to be indemnified, that the insurance policy fills the gaps. And a Side A or CODA policy drops down and fills in that gap that could potentially exist for a non-indemnifiable claim.